Welcome to the Daily Brief, where I'll go over the action in the market for Friday, February 24th, and then we'll see how things look for Monday, February 27th. We're still headed down. We had a pretty significant down day. A lot of damage is being done technically. However, we did go right down to the 200-day moving average, and we're camped right at about that spot. So we have to ask the question, is that support going to hold, or are we going to fall through that? So let's go back and talk about what happened. Right at the open, we had a gap lower open below S1 at 39.78, and then prices fell down to S2 at 39.44. As the day went on, prices did rebound and were able to get back up to S1, but that acted as resistance before prices closed down below S1. We were down 1.05% on below average volume, which seems to continue here. The technicals are more decidedly negative. We're looking to be a little oversold in the short term, a little bit in the intermediate term, and we're right at pretty significant support. This is all being fueled by the inflation and interest rate scenario, and that's what happened. The PCE report that came out on Friday was not taken very well, was seen as stronger than expected, showing signs of inflation, and that has really spooked the markets. That is also feeding into this earnings per share and valuation concern because of the rise in interest rates and inflation. We have the whole list of geopolitical concerns. There's talks here and there about a potential escalation between Russia and Ukraine, and NATO and the US may get more involved in that. We have earnings that are being released, although we're coming up closer to the end of earnings season, and nothing has really been done as far as the debt ceiling is concerned. Here is the intraday chart where we gapped lower below S1, went all the way down to S2. That was the low for the day, and we set a bit of a base here. We tried to launch up out of this a couple of times, but it really didn't take. We got back up to S1. That acted as resistance. We came back down and then ended up closing just slightly below S1. What are some comments that we can make? The PCE report showed inflation rather than disinflation. That had been the scenario looking back in the last week or two where it looked like inflation was getting under control. Well, this kind of suggested there is still some inflation out there, and that's producing a lot of concerns that inflation could reignite and start to go back up. This report also showed that there's a lot of spending potential going forward in this report, which of course could produce more inflation. The S&P did fall down below the 50-period simple moving average at 39.81. We came down to the 200-day moving average at 39.40, and as of right now, that is still holding. On a short-term basis, our stochastic, Stoch RSI, and Williams percent are extreme negative. And the PMO study, the CCI 14 and 20 on an intermediate term basis are also extreme negative. The dollar was up and interest rates were also up, and that produced some headwinds in Friday's session. We still have all of our yield curves that are inverted, which are pointing to a recession happening in the future at some point. Sentiment is still positive, though, even though it is dropping. The last time it was at 62. After Friday's session, it came in at 59. Looking at the condition of the trend, we're negative because the red line's on top. The ADX continues to drop, so that's weakening. Plus, we are below 20, so now we're in a trendless environment. Our bias is negative with the down day, and our momentum, I've also switched over to negative. Looking at the economic reports that came out, we had personal income, which came in up 0.6%, less than the 0.9% they had expected. Last time we had the report, it came in up 0.3%. That's not really what concerned the market. Personal spending came in up 1.8%, more than the 1.3% that was expected. Last time it came in down 0.1%. That produced a bit of a concern. The PCE prices, this is what kind of freaked out the markets. It came in up 0.6%. They expected it to come in at 0.4%. Last time it came in up 0.2%. And this is also what really caused a lot of waves through the market. The PCE prices, the core reading, came in up 0.6%. They expected it to come in at 0.4%. Last time it was at 0.4%. New home sales came in at 670,000, more than the 620,000 that were expected, and also up from the 625,000 that we had last time. Consumer sentiment came in at 67 with the final reading. They expected it to come in at 66.6, so this was just a little bit better. Last time we had this report, it came in at 66.4. Here's a look at the inflation nowcasting, and I'll also show this in the weekly video. The PCE and the PCE core inflation had been down below. Well, it really spiked up now, and they're predicting that inflation will pick up. And this is supposed to be the Fed's favored method for looking at inflation. And the fact that this came in hot just means that, okay, they might have to continue raising interest rates. And once they get them to a point where they're happy with that, they might keep them there for a longer period of time than what the market likes before they're willing to let interest rates start to come back down. Here's the consumer sentiment chart, the blue line just showing how it's improving slightly, but still it's pretty bad overall. And then we compare this with the red line, which is the 2-year yield. That's been going up. If you look down at the bottom, this is the spread between the two, where they have a tendency to go in the same direction. They're not doing that right now, and they have a tendency to not get very far apart from each other, even though they're on different scales. They're not doing that right now, so there's a real disconnect. But we've been seeing this for a lot of 2022 and so far into 2023. The Ulcer Index is ticking up, so it just shows that fear is starting to increase. Here's the VIX. It ticked up on the line chart and on the bar chart, whereas the VIX of the VIX is actually pretty much unchanged. It ticked down to slightly sideways in Friday's session. So volatility isn't really picking up the way you would necessarily expect if we were headed lower. This is still suggesting that even though fear is ticking up slightly, there's still a lot of complacency overall. Here's the ADX with our trend condition, where we have dropped below 20. We're below the moving average and the red line is on top. The daily chart shows how we came down through the 50-period moving average and we came right down to the 200-day moving average. We bounced up off of that slightly. Can that continue, or is this going to eventually break the support level? We also broke this upward trend line going back from the October lows, so some damage was done technically. Looking at the stochastics, we're getting to be extreme negative on the short term, intermediate short term, even though it's starting to turn back up, and we continue to decline with the long short term chart. Please be reminded that these are 3 subdivisions of the short term time frame. The Stoch RSI is still extreme negative, as is the Williams %R, and they can stay this way for a long time. This is a little bit positive. The Chaikin oscillator, haven't shown this chart in a while. It's actually turning back up. To have it turn back up on a down day looks a little strange, but maybe this is suggesting that we could bounce back up from that 200-day simple moving average. The CCI 14 and the CCI 20 continue to be extreme negative. Looking at our PMO study, we are extreme negative with the percent of PMOs that are rising. We're also getting extreme with the percent of buy signals, and we continue to decline with the PMOs that are above 0. The Swinland Trading Oscillator, based on price and volume, continue to be negative. The BPI is crossing below 50 after giving us an extreme positive reading, is starting to come down, so that is just suggesting more internal weakness. The NYSE Bullish Percent Index, which is a broader measure, after breaking out is coming back down and now starting to show more of a decline. The Chaikin Money Flow is still positive but is declining. The balance of power continues to be below the dashed line, so that's negative. And the TTM squeeze continues to decline, which is also negative. We're turning back to a brown bar on the go-no-go system. That is also negative. The CMB Composite Index, after getting extreme negative, bounced up slightly after Thursday's session, but is now turning back down. Looking at some of the other charts that we look at beyond bar charts or candlestick charts, we have the Renko, which is giving us a red box. That is negative. The 3-line break has black bars, which is negative. We added another 0 with the point and figure chart, which is also negative, and the latest signal is a bull trap that was generated on the 21st of February. Our short-term Fib levels just show how we broke down through support, and there's really not any support on the short term. Intermediate term, we've retraced down below this 38.2% retracement, so there's no real support yet for that. Longer term, we do have some support, but it's quite a bit below where current prices are at about the 38.26 level, and that's far from the 39.70 level where we currently reside. We're coming down through the moving averages now. The 20s are starting to roll over. We're below the 50, but we're coming right down to this simple moving average. We already bounced up off of it slightly. Can that continue in Monday's session? The elder impulse system for the S&P continues to be negative. The McClellan oscillator is getting extreme negative. And then a broader measure, which is the NYSE McClellan oscillator, it is negative overall, but not necessarily extreme. So this could suggest that the broader market still has a ways to go before it gets to be extreme negative. The summation index based on price and volume are both negative. Seeing a little bit of a breakdown with the new lows, so we're turning down with the 5-period simple moving average, and the 10-period is also turning slightly lower. The advanced decline line, we're still above the moving average, but we're declining based on price and volume. We're below the 0 point with the advanced decline ratio. This is another positive thing. Accumulation distribution actually advanced in Friday's session and remains above an advancing moving average. Volume just shows how it's continuing to drop off. When we're below 0 like this, that means that it's below average. The diamonds continue to be negative. The NASDAQ 100 has also come down to its 200-day moving average. Bounced off of that slightly. So we have the S&P and the NASDAQ bouncing up a little bit from their 200-day moving average. Is there going to be follow-through from that? The Qs continue to be negative. Small caps were also down after breaking through support. On the top, you see an RSI, which is declining and below 50. On the bottom, we have a declining MACD. Looking at the ratio between small caps and the S&P 500, it's still holding up quite well. It just means the small caps didn't get hit as hard as the S&P 500. The praying bottom fisher continues to generate a buy signal. The FANG stocks have just given us a recent golden cross. The dollar is bouncing up after coming down to this 101 level. We've been able to climb back up to the 105 level. Some updates of our possible positive scenarios after getting extreme positive with the 10-day average of the S&P 500 highs minus the lows, we're starting to come back down. And looking at the Amex, NASDAQ, and NYSE, after being above 0 with the 5-period moving average of the highs minus the lows, we're now dropping below 0, so that's more negative. The 2-year yield continues to go up, and it looks like it's taking out this spike that we had been working off of before to give some support to the market. Well, now we'll have to wait and see. Will this go up and spike and then start to come back down and give us a new spike to work from? The staples to S&P 500 ratio, after spiking up and then coming back down, it is starting to go back up. This is still a valid spike right now, but we're just not seeing a lot of follow-through based on price. What's our outlook for Monday? The technicals are negative, and we're short-term oversold. We have durable goods and pending home sales coming out on Monday. The whole list of geopolitical events. The markets are more fixated on the inflation and interest rate scenario unless one of these other things comes in and has a real impact. Looking at the Stock Traders Almanac statistics for Monday, we're neutral to negative with the Dow and the S&P, and we're a little bit more neutral to positive with the NASDAQ. We also have a tendency to be slightly more positive than negative in February. We're still working off of this positive backdrop with the trifecta because the market was up in January and it has a tendency to follow that 83 1/3% of the time. We also had the Santa Claus rally as well as the first 5 trading days. That gave us this 3-0 score. And when you take all of these 3 together, the trifecta, the next 11 months have been up 87.1% of the time with an average gain of 12.3%. And if you take the whole year, it's been positive 28 out of 31 times, which is 90.3%, with an average gain of 17.5%. And the market also likes that we are split between Democrat and Republican. We do have some speeches coming up in the week. I won't read all these off to you, but just notice that we have one on Monday, Thursday, and then another speech on Friday. Also notice that none of these speeches are being conducted by Chairperson Powell. Our scenarios can't go with the down one because we're not trending right now, even though we're negative and slightly oversold. We can't go with the up one unless you're really aggressive and think we might bounce off of that 200-day moving average, but we're certainly not seeing a lot of evidence for that. We're not seeing really any evidence for an uptrend other than a short-term bounce. So we're still going with the sideways scenario. Because the ADX is weakening, we're below 20, and the red line is on top, so that is negative. Our conclusion, the S&P is negative but oversold in the short term. Intermediate term, we're also negative and somewhat oversold. Long term, as long as we stay above that 200-day simple moving average, we have a positive backdrop, and that recent golden cross that has also provided more of a positive backdrop. Thank you. I hope you have a wonderful weekend. I will look at preparing the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video between the time I'm recording this and the open of the market for Monday's session.